So coming in from Australian broker, 1/3 of Aussie SMEs consider closing up shop. A poll of small businesses spread across the country have provided insight into how SMEs are feeling about the future in light of the Savasa sickness recession, with many respondents revealing uncertainty around the security and origin of their future funding. Scott Pack's SME Growth Index revealed that nearly 1 in 3 SMEs are considering closing or selling their business within the next 6 months if conditions don't improve, with the figure skewing even higher among smaller SMEs. While Scott Patt's CEO, John Sutton, noted the businesses were surveyed over 4 weeks in September and October, whereas November conditions are looking up. He called the results a warning for what may come should another lockdown occur or significant border closures remain in place. The research shows just how much so many within the small business sector have been hurting, he said. The data made clear that the smaller the businesses, the more severe the impact of the pandemic, with 2 out of every 5 SMEs with 1 to 5 million annual turnover looking to sell or close by April 2021 if economic conditions were not to improve in a big way. 1 in 12 small business respondents indicated they arranged non-bank funding facilities to deal with the impact of the Savasa sickness shutdowns on their supply chain and revenue, with a further 1 in 8 planning to add non-bank funding facilities once government stimulus currently in place ends. A quarter of small businesses expect to reassess their funding provider when the stimulus does end in April 2021. Given more than a quarter of SME respondents were covered by the stimulus, it's important to consider what impacts its withdrawal will have between now and April 2021, Sutton said. This is an issue that small business owners should take seriously. The financial aftermath of the Savasa sickness crisis is a call to action for SMEs to make the hard decisions about their business, how viable it is, what happens when ATO debts are enforced and other debts fall due, how to deal with the end of JobKeeper, and the best way to fund the business. And this is the thing, there's a big problem coming down the road when all this government intervention ends, the trading while insolvent ends at the end of this year, JobKeeper winds down, everyone has to start paying their debts. It's not just SMEs. We're seeing in the corporate bond market a lot of risk, and there's a lot of insolvency, and I as a trader, I look at the bond market, the corporate bond market, and there's a lot of junk bonds there. I know the Fed have come in and bought bonds, but that's simply just changing the ownership of those assets, of those debts. Those businesses still need to pay it, or they can default on it and go under. So we're seeing big problems in the bond market, in the corporate bond market. There's a massive solvency issue around the corner. Many people I follow, Chris Cole is probably one of the best investors, best hedge fund managers I've ever known. Just recently said that that he expects a massive issue in the corporate bond market. Peter Schiff and many others are saying the same thing. I actually believe the bond market is the biggest bubble in town, bigger than anything else, any other asset class out there. But that's just my opinion. I've seen here in Australia, I've seen economists and financial analysts do some numbers, and they're estimating when JobKeeper finally does end. Now, most of those people on JobKeeper will keep their jobs, but I've seen analysis. They're expected, 500,000 to 700,000 of those people will lose their jobs and will go into a job seeker or the dole, whatever it ends up being called, once this all ends. And so unemployment is actually expected to increase once JobKeeper ends. So the pain of this recession really hasn't been felt yet, as I've said in previous videos. The pain is still to come, and I just suggest to everybody that you should prepare now. Prepare now. Get your finances in order. You know, to get through what I think is going to be a very difficult period moving forward. But also, you might be in a position where you can prepare now to capitalize on that. So I can say that I've recently, in the last little while, bought some businesses and bought some stocks that were trading that were just completely beaten down, and were trading at two to three times earnings. Dividends, 18-20% dividends. So the returns on those things are very good. But I've been in a position to jump on those when they were beaten down, and now then that's the thing that you can do, is when that next opportunity comes, you can jump on it. I'm going to do a video about how I've been investing and how I'm looking to allocate capital in the next 12 months ahead and beyond. And so hopefully that will give you a little bit more detail and a little bit more info on what I'm doing and how I'm seeing things, and the different sectors that I'm invested in, the different sectors and businesses that I'm looking at accumulating over the next 12 months or so, and different asset classes. So there you go, folks. There's still a lot of pain to happen. There's still a lot more businesses that are going to go under. Businesses are the ones that employ people. That means job losses. We've got a lot of problems, and when we've got the highest debts in Australia, we've got the highest household debt to any kind of ratio you want to use, and compare that to any other jurisdiction around the world. We are now starting to rack up some pretty huge government debt. Now, people always use the argument, but compare that to Japan. No, we should never be comparing ourselves to basket cases around the world. And yes, Japan is a basket case. I hate this comparison. It really annoys me. Like, that's all right. We can still jump off this cliff. Doesn't matter. Just stupid. But we've also got high corporate debt, so business debt. We've just got high debt levels everywhere, and so I see a lot of businesses going under, a lot of households going under, a lot of pain. I don't know how the government will continue to prop things up moving forward. If they continue to try to prop things up and not allow that creative destruction, which economist Joseph Schumpeter talked about, then we don't have capitalism anymore. Because the creative destruction is an important part of capitalism. And so if we don't have that, then we don't have capitalism. And if the government wants to continue to just issue bonds and have the central bank basically monetize that because no one else is really buying it, then we're going to have a problem with our currency. We're going to have a problem with our currency. And Australia is in a worse position doing this than, say, the US. The US is the global reserve currency. Australia is not. There is not a demand for Australian dollars outside of Australia, like the US dollar has demand all around the world. So we have to be very, very careful. I am very concerned about the near future as all these things start to unwind, and we, as Warren Buffett says, when the tide goes out, you see who's swimming naked, and we're certainly going to find that out soon. So thanks for joining me on this episode. Don't forget to like and subscribe and share the channel. Get more people checking out this content that I put out there. Hopefully you enjoy the content. Hopefully it better educates you and so that you can prepare for yourselves and your families. But thanks anyway. I'll see you again on another episode of Finance Uncut.